Caroline Stephen here, financial journalist. Our special guest on Talking Trading today is proprietary trader Richard Jackson, the founder and owner of Jackson Capital. Richard walks us through his trading journey from when he first started trading and he lost some of his girlfriend's money to when the markets really clicked for him a few years later and they became like seeing the Matrix. Also an experienced EA writer, Richard gives his opinion on algorithmic trading. And Richard's one of the few people we've had on Talking Trading discussing the topic. And he talks about his 180-degree swing from writing algos to then believing that a human being can interpret the charts and the markets better than a machine.
Hi, I'm Janine Alice, founder of Boost Juice Bars and Shark on Shark Tank, and I listen to Talking Trading.
Richard Jackson from Jackson Capital. Hello and welcome to Talking Trading.
Thank you for having me.
Tell us, first off, about your background and history in trading the markets.
Well, I guess when I started trading, I started in the equity space. Before that, I didn't really come from a finance background, but more of an electrical engineering background. So RMIT was where I did my electrical engineering, and that gave me the ability to, I did learn how to code computers and a little bit of computer science in there. So that's, and having that engineering view of the market, has helped me and I guess inhibited me a little bit as well. But I started off trading equities, and that was good, but it was a little bit too slow for me. I wanted something a little bit more exciting, I guess. So I moved over into the derivative space, trading futures through the Chicago Board of Trade. That started around about 2003. The fun part came in 2008, experiencing limit downs, on a few nights in a row, and the massive volatility that came along with trading index futures during that time was very exciting. But then I moved over into, and I couldn't, being an index futures trader on the US session, you've got to stay up all night, especially with, using 377 tick charts, etc. So they kind of wore thin after a while. Then I moved over into the FX space. I was touching FX quite a lot, but because it was, traded 24 hours a day, I wasn't limited to the session times of the US stock market. I could, trade it 24 hours a day. And the liquidity was there. It was great liquidity, enough volatility as well. Now, I guess I trade, strictly major currencies, major indices, and some common commodities, gold, silver, oil, using CFDs on the derivatives market.
Okay, so let's get to what you trade in a minute. I just want to make a comment that I have noticed from all my experience that engineers make very, very good traders.
Yeah, I guess so. There's also engineers. Some engineers can be inhibited as well because we're working in an environment which is chaotic. It's stochastic in its form. So engineers need to be able to relax that there's no certainty in trading. Because we're working in a probabilistic outcome. We have to work in the law of probability. So if you're a scientist of some sort and you know quantum mechanics works in the area of uncertainty and probability, and that really helped me a lot as well to release a lot of the idea of a certain outcome, like physics is certain, to move over into a mathematical environment where probability is more the key.
Okay, let's talk about trading the derivative markets. What's involved and how is it different to trading equities from the Richard Jackson point of view?
Well, a lot of retail traders out there, I guess, trade equities for a long-term buy-hold type scenario, maybe looking for dividends. So, you'll get guys out or, retirees or people looking for a longer-term outcome where they collect their dividends for income purposes. What we do with derivatives is because we don't actually hold the underlying asset at any one time. We they're just purely as speculators, and we speculate on the market price moving up or down in either way. The currency market is good, and there's no upward bias to the currency market. So we can easily go short as we can go long, but with derivatives, we're usually in and out within the same day, up to 5 to 6 days later. So we take a lot more trades, and we take an idea that over time that we will profit out of the market based on speculation only.
So going back to the specific markets you trade, you mentioned gold, silver, oil. Talk us through that and what your style of trading is.
Well, our style of trading is, we've got a number of different strategies that we work with here in our firm, mainly swing trading strategies. And also news release strategies, which we take advantage out of differentials between the actual and consensus of certain news releases. If they're big enough, then we'll take advantage of it. So commodities, we will touch on the commodities if there is fundamental news announcements which will give us a reason why we should get into it. Things like changes in OPEC supply demand, also with the US dollar, which is, basically that's what you're trading when you're trading gold. Other indices that we'll touch on, the NASDAQ, the Dow Jones, DAX in Europe, and FTSE.
Okay, so I just want to make this as relevant to our listeners as possible, because our listeners trade. So tell us, what are your 3 biggest lessons from trading? What have you learned?
Well, I guess because we're active traders, and we're not investors, my clients, when they come and invest with us, they invest in our ability to trade rather than the underlying assets or the derivatives that we trade. So they're investing in us as people. And the biggest lessons that I guess I've learned is, how to have a strong psychology and correct behavioural misnomers in a trader. And that's what I do with a lot of guys that I train as well, is, 50% of how I train them is not the entry, the exit, the underlying fundamentals, it's their behaviour. Things like cutting your winners short, letting your losers run, moving your stop loss, lack of confidence, fear of getting in, what I call FOMO. Somebody may have heard of this acronym FOMO, fear of missing out, clicking off at anything. So having a good record of what your trading history has been like, having a mentor as well will typically fix a lot of those behavioural issues.
So whenever I get a market wizard on the show, I always ask them what their best trading experience has been and what their worst is. Let me ask you that question.
Oh, wow. That's a good question. I guess the best trading experience is when, the first 5 years when I started trading was terrible. I borrowed $30,000 off my girlfriend and lost it all. I wasn't very popular, but that really gave, I could either have done one of two things: give up, or go and do it properly. Right? So 30 books later, after reading, really great books from Carolyn Boroden. Another one is Harmonic Trading by Scott Carney, Mastering the Trade, etc. There's some really good books out there. Steve Nissen, Candlestick Charts. I went along and I went and learned properly. I also went and got a mentor who was experienced at trading, who really gave me some of the nuances, and then it was just practice after that. So
how long did it take for you to become competent?
5 years. 5 years. But, ever since, once it clicked. It's like seeing The Matrix, It all got together. I started being confident. I started being disciplined at what I was doing. And then from then on in, it was all uphill.
How would you recommend traders build their confidence?
Get a mentor. Get somebody who has done it in the past to teach you the lessons that will take you probably 2 or 3 years to learn yourself. Because if you get a mentor, instead of you sitting in your house or in your bedroom or whatever it is, meandering all over the place, making all these mistakes, changing your strategy every 5 seconds, all those sorts of things, a mentor will keep you on track. Okay? Make sure that you don't deviate from what you're supposed to be doing. And that's probably the best thing that I could probably recommend to anybody out there.
So, Richard, that was your worst trading mistake. What's been your best trading experience?
limit down on the S&P 500 in 2008. When you're already short and the S&P 500 opens up, limit down 3 days in a row, that's an easy day.
Realistic returns people can expect from trading derivatives.
Well, that's right. Well, the thing is, because derivatives are amplifying gains, people think they can make 100% in 3-4 months out of their trading. In doing that, you take so much risk, because risk and reward is a balancing scale. If you take a lot of risk, then you have to accept a lot of sorry, I'll say that around the other way. If you want a high reward, you have to take a high amount of risk. One does not come without the other. You know, I've had clients come to me, I want all the upside, but I don't want to take any risk, right? It just does not work like that. So the realistic returns that you can get, you know, our firm, you know, looks to return 20 to 40% in a year. So, you know, if you're looking at it, but you've got to be good, okay? But you've got to also expect that if you want 20 to 40% in a year, that you're going to risk 20 to 40% on the downside as well. So, you know, you've got to really make a decision of whether that's the right type of style for you, because all derivatives trading is a high growth, high risk type of product that you need to get into if you want to get into it.
Let's go to algo trading. What's your opinion on it?
Well, algo trading, you know, it was very popular. It seemed like an easy solution for a lot of retail traders out there. MetaTrader 4 has a, you know, MQL4, which you can code into the computer. You can also get other people to write code for you. The mistake a lot of retail traders make as well is that they go onto the internet, find an expert advisor that will, you know, that looks all pretty and nice and glorious and all those sorts of things, but they don't actually know how it works, okay? My opinion of algo trading is that, you know, in my past, I've written over 800 EAs in the past, but, you know, they all have their day in the sun. Right, it's very easy to curve fit an EA to historical data, but it's very difficult to be able to predict the future as well. A lot of people get historical backtesting incorrect by not understanding the limitations of historical backtesting. So algos have a place if you're running arbitrage, latency or triangular arbitrage of some sort. It does have a place, but that's obviously high risk. And you do need to be a computer scientist to be able to get the low latency out of the computer setup. But for the retail trader stuck all the way over here down under Australia, especially Melbourne, we're probably the furthest away from anywhere in the world, that it's not really viable for anybody to run an EA or latency EA on their computers. Even if you've got, you know, VPSs in LD4 or NY4, you know, there's still a certain number of node points that you need to go through that will limit the speed of the execution. So, yeah, well, latency arbitrage is probably not something that I recommend anybody to get into unless you've got, you know, PhD computer scientists around you. But you know, I've swung, you know, probably a full 180 from writing algos in the past, but to now really, you know, enjoying, you know, the guys who work for me, because a human being can interpret a market or interpret a chart with a lot of different layers that can be written into a syntax of MQL4 or any other syntax of C# or whatever it is that you're using.
Richard, tell us briefly what's unique about Jackson Capital.
Okay, I guess Jackson Capital is, we are two parts. Mostly we are a proprietary trading firm through Lepus Proprietary Trading. And we're also an agency side, so we also get client money in through Jackson Capital. We educate people coming through to be traders. The top 1% of traders that come through end up trading our capital for us under my management.
And where can people go to find out more about Jackson Capital?
Well, I'd say if anybody wants to have a look, go to jacksoncapital.asia or have a look at lepusproprietarytrading.com.au. Richard,
thank you for your time today.
All right, thank you.
And that's it for this week's episode of Talking Trading. Thanks to Louise Bedford and Chris Tate, who fund and sponsor this show. And as always, if you like this show, tell a friend. This is super important because word of mouth is always the most powerful way people can get in touch with us. Next week on the show, we hear from property expert Michael Griffiths. So until next week, happy trading. The views represented on Talking Trading are general in nature and do not take into account your objectives, financial situation or needs. Before acting on any of the information, consider its appropriateness in regards to your own situation.